Perfect. Looks like we're live. Welcome everybody to the Property Factory's April webinar. We're in April already. The year's going quickly, Andrew.
Isn't it just? Yeah. It's taking along.
Yeah. My name's Alex. This is Andrew.
Thanks.
We will be your hosts tonight. Andrew, as I said, April. We're getting through the year quickly. How's everything going?
We are.
How's the property market looking?
Well, I'd have to say it's better than last April. That's for sure. Yeah, we're definitely seeing a pickup in definitely the new build market, I'd say this year, as I said in the last webinar. So yeah, I mean, still slow out there, but we're definitely seeing prices starting to rise. And it looks like, interest rates are going to come down hopefully sooner than expected. Inflation looks to be getting under control. And I seen a SPS rate the other day for 5.99 for I think it was 3 years. So I think I think things are looking more and more positive as we go along.
Yeah. And inflation coming down sooner than expected because interest rates because of inflation?
I think just because of inflation. I think I think last time I saw it was down to 4% year on year, which is getting closer and closer to the Reserve Bank's mandate. So and obviously we've seen the country's in recession for the second quarter in a row. So obviously the Reserve Bank looks at that sort of thing, and that's going to have an effect on when they lower the OCR, which obviously makes a difference for us. So and property investors.
Low interest rates probably not a bad thing for property investors, right? Lower interest rates.
I wouldn't have thought so.
No, not that anybody wants to be in a recession by any means, but we certainly all want inflation under control. Look, thank you everybody for tuning in tonight. As I said, I'm Alex and this is Andrew. We're going to be your hosts tonight. And today we're going to be discussing how to run the numbers on an investment property, whether that's an investment property generally speaking or specifically. Is really up to you and how you use the spreadsheet we're going to actually provide you with at the end of this webinar, which is super exciting. So we have built a spreadsheet, and it's a spreadsheet that we use often here at the Property Factory. And what we're actually going to do is everybody that is in attendance at the end of the webinar is certainly going to receive the spreadsheet. But what I'm going to try and do is convince my good friend Jonathan, who's sitting directly in front of me, to send it out to everyone who is on the webinar, because I'm just conscious of the fact it's a public holiday tomorrow. Everybody's probably busy, and some may not be able to stay for the entire time. But what we'll do is we'll run through, obviously, the webinar. We'll talk a little bit about the spreadsheet, how to use the spreadsheet, and then what you'll be able to do tomorrow morning, it'll be sent out tomorrow morning, is actually go through some of those numbers yourself, familiarize yourself with the spreadsheet. Obviously, you will all be experts on how to use it come the end of this webinar, and you'll actually be able to play around with it yourselves and do some of the analysis yourself. So it is a cool tool. It's a fun tool to use and a really great tool for making comparisons on properties. Just a little bit of housekeeping. For those of you that have been to the webinar before, what generally we do is answer questions at the end. But I'm just conscious of the fact that this webinar will be a little bit more quantitative than probably qualitative. It's slightly more specific than general. A lot of our webinars, I guess, are relatively general. We can answer the questions at the end. So what we're going to do is endeavor to answer questions throughout this webinar, because I'm just conscious of the fact that they may be specific to a number or an assumption we're talking about at any given time point. So I think it's probably easier that way, and it'll sort of beef out the webinar as we go as well. Anything to add to that, Andrew?
Not at this stage. No, I mean, as you say, we'll answer questions along the way. Because it is a bit more specific, and you might have specific questions about, one of the spreadsheets we're looking at, or something like that, which is probably just easier to answer at the time than at the end to flick back to it.
I am also conscious of the fact that some of the attendees will be relatively seasoned investors. They'll have a good understanding of the numbers and what to look out for when it comes to the numbers and property investment in general. Others will be complete novices. So we're doing this webinar essentially on the basis that everyone is a novice. If you're seasoned and you know what you're doing, you may still pick up, a few tips and tricks here and there. But ultimately, not everybody is an expert when it comes to property investment and how to run the numbers on an investment property. Our job is to educate. That's the purpose of this webinar. So please, if you know what we're talking about, then stay tuned, because you'll receive the spreadsheet and you may pick some things up along the way. But if we talk about things you already know of, we are just trying to look after everybody, essentially. Yeah. So what I'll do now is I will share my screen. I don't think we've got anything to add let's get into it. No, I've got my little gadget here. Okay, wonderful. Right, how to run the numbers on an investment property. What we're going to do first is just cover a couple of topics in relation to the Property Factory and what we do. For those of you that have attended before, I'm sorry to repeat this, but we do have new people turning up every week. So it's important they understand a little bit about the Property Factory and a little bit about what we do. Because obviously, yeah, we like to think we know what we're talking about to an extent, although sometimes I wonder. No, I'm joking. Right, here's what we'll be covering. Who is the Property Factory? We'll look at a couple of different factors in terms of the numbers. So we'll look at some cash flows and some capital growth rates. We'll also run through the spreadsheet, obviously, and then we'll look at a case study. So that's a specific example relating to a development we actually have listed currently in Dunedin. And yeah, we'll just use that as an example. And then obviously you can go away in your own time and use the spreadsheet and look at some other examples. As I said, in terms of the Q&A, please just ask as we go. We will endeavour to answer those questions throughout the webinar. As I said earlier, please stay to the end. We'll share the spreadsheet with everybody that stays to the end, although I will put in the good word to my good friend Jonathan and ask him to send the spreadsheet to everybody. Whether he says yes or not is up for debate, but I think he's in a good mood tonight.
Looks like.
I think he's in a good mood, so time will tell. Right.
So,
what do we do at the Property Factory? Andrew, you're the expert, you're the boss. You tell me, my friend.
well, basically, a lot of you guys watching the webinar probably already know, but for you guys new to the webinar or haven't seen the Property Factory before, we're basically a new build specialist real estate agency.
Yep.
And the idea is that we work with a lot of different developers around the country and analyze a lot of stock out there, new build stock. And basically what we're doing and what Alex is doing on the listing side of it is working out which deals are the best deals pretty much. And these deals end up on our website, on our deal pages, which you'll be able to see there.
Yep.
And basically they're the best deals in each location, but we have a whole lot more stock than that, which I'll talk about a bit more in a couple of slides. But basically the best deals end up on the website, and the idea is that we do a lot of the work for you guys because we run these cash flows on every development on our deal pages, and all the work's done for you. We've made all the assumptions for you, got the rental appraisals, and compared pricing in the market, looked at historical capital gains in these areas, and forecast it forward. All these things are quite important, as you'll see when we start looking at the numbers. All these things that we're looking at when listing projects are very important when holding a property, especially for 10 to 20 years, because it makes a big difference in the long run, as you'll see. So that's basically us. We have a lot of tools, which I'll talk about soon, that we help use, I guess, or our team uses to help investors find the best properties for them out of the best deals that we have on our website. Yes, that's basically us in a nutshell.
Yeah.
And
as Andrew said, we like the deals on our website are the tip of the iceberg in terms of what we actually have listed. We do try and rotate the listings on our website relatively regularly just to keep it somewhat fresh. But to be fair, we think most of the deals on our website are a good deal for whatever reason, and I guess they all differ in reasons. But
that's right. And I guess because different investors need different product depending on their situation. So not every deal on our page
will work for
every investor, but there should be at least a few that work for each one of you guys.
And hey, if you're not an investor, you're a first home buyer, you just want to learn about property investment, that's why you're here. There are a number of deals on our website too that would make really great first homes. There's some really attractive price points there. And we've got a number of tools as well, which we'll talk about in a second, that can be used to figure out what is the best property for you and your financial circumstances. Obviously, location preferences and that sort of thing come into play when it comes to a first home as well. So, yep, just sort of reiterating what we've said. What do we actually do with the property? Now, I'll cover this really, really quickly. So we do developer due diligence on all of the developers we work with. I think we are working with about 50 different developers, or we have worked with about 50 different developers. At any given time, we're probably actively working with around 20. And when I say actively, we're sort of keeping in touch with them on a weekly basis, seeing what stock they've got and really scouting out the best deals in the marketplace for our buyers. But we certainly have relationships with around 50. So we do all of our due diligence on that developer, make sure that they actually going to do what they say they're going to do. And to date, touch wood, we have never sold a property that hasn't been completed. So I think that's a really good testament to the due diligence we actually do on developers. Of course, sometimes projects take a little bit longer than expected. There can be issues with council and that sort of thing. But to be completely honest, in the current market, I don't think it's a bad thing if a development takes longer than expected, because interest rates are obviously high. The cost to own a property is tough for a lot of investors at the moment. And so there is opportunity there to, put down a deposit on a property now, wait a couple of years and settle on the property then, without paying that sort of higher. Well, and in 2 years, we'd hope the interest rates are a little bit lower. On the other side of the coin, sometimes developments happen quicker than expected. But for the most part, they're sort of within 3 months either side of the expected completion date. In terms of being off the plan specialists, we are off the plan specialists. We really only sell new build properties. So when I refer to a new build property, that's either something being sold off the plan or something that has been recently completed. Now, what you'll find is developers, obviously their sales team are always going to be new build specialists, because again, that's all they sell. But traditional real estate agents, for example, aren't, because they are used to selling existing homes. And what you'll find is that the purchasing process is a fair bit different than that of when purchasing a new build is a fair bit different to that of purchasing an existing property. So it is important you are purchasing off somebody that knows what they're talking about in the new build space anyway. All of our pricing is pre-negotiated. So what happens is when we start a relationship with a developer, I'll actually sit down with them and try and work out a price point that works for both our investors and also the developer. Because at the end of the day, the price does need to work for both parties. There has to be margin in the project for the developer, but at the same time, the price has to be attractive for the buyers. There are a lot of deals. There are a lot of listings out there at the moment, and we certainly make sure developers are aware of the fact if they don't sharpen their pencil, buyers are going to look elsewhere. So, while there might be a little bit of wiggle room when you make an offer on a property with the property factory, we think most of our prices are pretty sharp from the start, to be fair. Obviously, we have investment knowledge as well. While we're not financial advisors, we do have relatively sound knowledge, I like to think, when it comes to property investment and how the numbers work, hence this webinar. What you'll find is developer sales team typically don't know too much about property investment, unless maybe you got the right salesperson. Real estate agents don't know either. I mean, they know a good location, they know a good price point. They don't necessarily know the nitty-gritty in relation to the numbers. And of course, when it comes to purchasing off the plan, it is important that you have people in your corner when it comes to settlement, because if the property isn't up to scratch, come settlement, and you're purchasing a large development, it can be hard for your voice to be heard. So I think it is important to have somebody, or at least a company, with a little bit of clout with the developer. And when I say clout, I mean, have made a reasonable amount of sales for them to be in your corner and help you solve any issues that may go wrong during settlement. But I'd like to think most of the developers we work with, in fact, all of them, would be pretty upfront and honest when it comes to any issues come settlement.
Cool. So what do we offer at the property factory? Well, we've spoken a bit about this already. As I said previously, we've got one of New Zealand's, we believe we've got New Zealand's largest new build stock list. And as I said, the properties that are on our website are the tip of the iceberg, really, when it comes to the level of stock we do have. So even if there was, you were looking for something that wasn't necessarily on our stock list, still get in touch with one of our team, because there's a heap of other properties there that maybe, may suit you. And especially even first home buyers or just homeowners, a lot of that stock, probably the best deals that go on our website they stack up best for investment, but there's a whole lot of other projects there for homeowners as well, first home buyers, and even, you know, people upgrading, downgrading, that sort of thing. So yeah, there's a huge amount of stock there, and generally we could list with most developers around the country if we chose to. So plenty of stock. So that's one of our big advantages. Cash flows and forecasts. So we're going to be talking about our cash flows tonight, obviously. We run these cash flows on all the projects on our website, so you can get a real clear idea straight away of how that property stacks up as an investment and how it compares to other properties on our website as well. By the end of the webinar, you should be able to plug other properties in that we aren't selling and see how they stack up against our properties as well. Because, you know, most of those properties out there, we've probably had a look as well and stacked them up and, you know, just had a look to see how they look. And probably a lot of these projects we've looked at. Investment analysis and research, again, same sort of thing. So we're obviously doing all the analysis for you. Really important, you'll see tonight, to get in good areas for capital gain as well as yield, and we'll see just how much of a difference a little bit of I guess capital gain percentage makes over like a 10-year period and even longer as those, you know, capital gains compound. We've also got the inside information, which Alex mentioned a bit already, around the fact that, you know, different developments, when they're in different stages of the process, there are deals to be had. At the start, you know, developers might want to get a few underway, so that they might sell them a bit cheaper. Once they made pre-sales, they might do a few lower deposits and that sort of thing. Some developers might want to clear some stock to move on to another project and all these different things. So we have the inside information on all our developers and the different developments that they're doing and where they're at in the process, and, you know, where we can get deals and what sort of deals we can get. Also the investment capacity report, as we've spoken about previously, but for you guys new to the webinar, this is the report that anyone can go onto our website and fill out. It's called the investor report up the top on our website. Really great tool. And basically what it's doing is looking at your own personal balance sheet, and it looks at your situation like the bank looks at it, but we're looking at it from a purely an equity point of view. How much equity do you have as security over new debt? And then we look at it from the point of view of, okay, that's great, but how much income do you have to service that debt? And then we look and say, okay, well, can you borrow more money based on income, or can you borrow more money based on equity? And once we've looked at this, we work out where you're weak and where you're strong, and we recommend properties based on your situation and your budget. Because the biggest thing with property investment, really, when you're trying to buy, if you're trying to build a portfolio, is running out of borrowing power. So the best, I guess, the best you can set yourself up here, it makes a difference further down the track when you're buying your, say, second, third, fourth properties.
Yeah,
you really need to be set up correctly. So that's in a nutshell what we offer at the Property Factory.
Mm-hmm. And I mean, that's why it's important to run the numbers as well, so you don't potentially run out of borrowing power.
That's right. Yeah.
In terms of our track records, we have sold over 345 properties to first-time investors and existing investors. A fair few to first-time buyers as well. As I said before, we work with a whole lot of different developers. These numbers are always changing as we sell more properties, obviously. And to date, we haven't sold a property that hasn't been built, which I think is a pretty good track record, pretty fair track record, and something we're certainly proud of. So we, you know, are doing our best to keep it up, and yeah, always want to help more and more investors and first home buyers into properties. So let's get into the crux of it. That's the boring part over. For those of you that have heard that before, I'm sorry. We just need to make, as I said, new people conscious of what we do. But what are we going to talk about tonight? We are essentially going to cover, when we say how to run the numbers on a property, it's really how are we going to measure the performance of a property over a given time period. And the time period we're going to look at is 10 years. It could be longer. When I say 10 years, I mean, typically we recommend buyers or investors hold a property for at least 10 years, because that's probably the, you know, unless the market is super, super hot, you really need 10 years to realize at least a good amount of that property's potential, right?
Yeah, that's right. Well, you'll go through a couple of cycles in that time period. And yeah, I think that's a fair, we would recommend holding the property for at least that long. You'll see you can run a spreadsheet for or a cash flow for 20 years. And if you do that, you'll see
Yeah.
I guess evens it out further and you'll see more significant growth. But
We could do it forever, but we'd be here all night.
We would, that's right.
But we love our job, so we'd happily sit here all night and do it. In terms of, we're also going to look at cash flows, some capital growth projections, and then, as I said earlier, we'll do a case study on a lovely Dunedin development we have on our books at the moment. Yeah. Anyway, let's get into it. Just a quick disclaimer: this is not personalized financial advice. We're not financial advisors. We do have a sister company, Thrive Investment Partners. They are financial advisors. We're not. But yeah, so the information we present is based on our opinion and essentially our research and understanding of the property market. But we do like to think that we have a reasonable understanding of the property market, and certainly the assumptions we use in this webinar and in the cash flows, I guess, are assumptions that we are confident in and that the property market has experienced over the last 10, 20, 30 years, for example. Just on that, I mean, because something has applied, say an assumption is applied for the last 20 years, doesn't necessarily mean that it will apply for the next 20 years, but generally history repeats itself. And the last 20 years, for example, is probably as good an indicator as you're going to get as to what's going to happen going forward. And so we try to base most of our assumptions on history.
Yeah, and I would say what we base our assumptions on is pretty conservative. And there is some talk out there that maybe property prices won't go up as much in the next 10, 20 years as they have in the past 10, 20 years. But, the Reserve Bank's had the same mandate since the early 90s, and, prices have done what they've done. So, I mean, the mandate hasn't changed. And obviously interest rates and inflation and all these things, really, they're the main drivers for property prices. So, I mean, if they're not changing, then probably, property price rises aren't going to change a whole lot either. So, but we never know what's around the corner, as Alex said. So
we try and
base it on the best information we have. And we also look at, what different institutions are doing forecasting forward, like the Reserve Bank. And we're looking at what their forecasts are as well. But they don't always get it right either. So
we try and keep our assumptions, and we'll talk about our assumptions a little bit more shortly, conservative. Might just bring the screen down because I'm conscious of the fact that light bulb's in the way. Sorry about that. Okay, there we go. That's better. Now, in terms of running the numbers, it can be complex, but it doesn't have to be. Like, if you were to sit down and build your own spreadsheet, that takes a lot of manpower and a lot of time. We've obviously done the spreadsheet for you. It's super straightforward to use. There's literally probably less than 10 inputs on the spreadsheet. All you need to do is plug in those numbers and it'll spit out a forecast for the next 10 years. So while this slide states running the numbers can be complex, I guess the point is it doesn't have to be if you have the right people in your corner and you're using the right tools. And that's a big part of our job at the Property Factory, is to take the headache out of property investment and figuring out, I guess, what differentiates a good deal from a bad one, and what is a good deal, and what's the average one or a bad one, for example.
Yeah, that's right. And all the formulas are written in behind the spreadsheet. So you really only got to put, as Alex said, a few numbers in there, and that should spit out what you require to be able to, I guess, compare projects and rate them and see how they perform. Yeah.
So when we're looking at a deal or a property, and my job at the Property Factory is so I look after the listing side of things. Essentially what will happen is developers will ring us or we'll ring them. And what we'll do is sit down with them and try and figure out whether or not their development is what we would consider a good deal, and whether it is worth pushing to purchasers we're working with at any given time. And so there's numbers we take into account when looking at that deal. And I guess that sort of ties in with what should you as an investor be looking out for when assessing an investment property. Probably a couple of figures that spring to mind initially are gross yield, net yield, cost to own, for example. Capital growth is obviously a super important thing for a lot of investors, because at the end of the day, that's probably the main factor that makes one sort of wealthy over time. But yeah, there's sort of what you find in these cash flows or spreadsheets is there are a whole lot of numbers, and they're all important, don't get me wrong, but there's probably 5 maybe that are the big ones that as an investor you really should be looking out for. And what we'll do in this webinar is actually emphasize what you should be looking out for and why they're important.
And it's really a balancing act, as you'll see, between capital gain and yield. Because if the capital gain's super high, then probably the yield's quite low, and your cost to own will be horrific. And if it's the other way, you won't get a whole lot of capital gain, so you won't build your wealth over time. But it may be more manageable to own. So it's a matter of finding something. A lot of our projects are sort of in the middle where there's a good balance there. So we're maximizing capital growth by, I guess, the sort of property and the location, etc. But we need to get a decent yield, otherwise, especially with high interest rates, it's too expensive to own. So it's a matter of finding that balancing act.
Yeah, there certainly are a couple of anomalies, but generally speaking, there is a trade-off between yield and capital growth, and it just comes down to an investor's circumstances and financial preferences in terms of which one of those figures they chase, essentially. But I guess the first number we look at when, especially in a high interest rate environment, when determining whether a deal is a good or a bad one, is the gross yield. So essentially the way we calculate the gross yield is the annual rent, so the rent that property receives on an annual basis or could receive, so it doesn't include vacancy, divided by the current value of the property. That will give us a figure, or should give us figures to, I think, one decimal place. If we multiply that by 100, we'll get that on a percentage basis. So, I mean, what sort of yield do you think we're looking for when assessing a property at the moment, Andrew?
Look, I guess it all comes down to
and
location.
Why is the gross yield important, I guess, is the other question.
It all comes down to location, but we'd be really looking, the best deals we've got at the moment probably have a yield of north of 5%. And the higher you can get, the better. Sometimes gross yield is a pretty good measure of, and it's one we'd run regularly at the property factory because it's quick to run and it gives you a reasonable idea of how the property is performing based on other similar properties in a location or in a city. There's also net yield, which Alex also mentioned, which probably is a more accurate measure. And what net yield is doing is looking at the gross yield and then taking away the expenses. This is probably more important. A net yield's more important when you're comparing properties of, I guess, different typologies, because sometimes an apartment might have a really high gross yield, but the net yield might be quite a bit lower because it might have really high body corporate fees or something like that. There might be 3 lifts in the complex, and there's a lot of maintenance and that sort of thing, and you might have an $8,000 body corp yearly fee or something like that. But when comparing townhouses like for like, a lot of the expenses are actually very similar, so probably net yield isn't so important in that case. And even when comparing house and land packages, the way the expenses are split or broken up can change a little bit, but the actual numbers don't change a lot. So gross yield works pretty well most of the time. You'd only really be getting into net yield when you're different typologies, as I said, and you got body corp fees versus fee simple townhouses and all this sort of thing. So I mean, what do you think about that, Alex?
Yeah, no, I agree. I think like around the office, for example, generally we throw gross yields around, and that's just because pretty much all of the properties we have listed or are recommending are relatively similar. We don't have really any apartments that I can think of listed that have exorbitantly high body corporate fees.
Not a huge amount at the moment. We have at different times, but not right now.
And we certainly don't recommend leasehold apartments in central Auckland, for example. I can actually think of an example a couple of years ago. It was Brian, one of our old colleagues. He saw a Trade Me advertising or advertisement, should I say, and the headline of the Trade Me advertisement was something along the lines of gross yield. Oh God,
it was 20% or something like that.
High.
It was really high. Yeah.
And we're like, what? And so we actually delved into the numbers, and it turns out it was a leasehold property in Auckland, which had very high body corporate fees and
had a ground lease on it as well. So, and you didn't actually own the land, you only owned the building, which will depreciate in value over time. So you don't get a whole lot of capital gain out of that, only the building inflation. So, and we had one of our clients was looking at that as an investment and trying to compare it to one of our properties. So in that case, a net yield versus gross yield is quite important. So it just depends on what you're looking at and what you're comparing.
So what we found in that case was the gross yield was obviously really attractive on that particular property, but when you actually delved into the numbers, the net yield on the property the client was looking at and the property we were recommending was actually very similar. In fact, I think the net yield on, I believe it was a townhouse, was
I think the house was better.
Yeah, it was better. So
I think the leasehold one come out, the net yield come out at about 3% or something like
yeah,
that.
and I can't imagine the capital growth on that leasehold property would be
No.
overly attractive either. So yeah, it is just important to be conscious of the difference between the two. But I think as a rule of thumb, provided the properties you're looking at have relatively similar characteristics, for simplicity's sake, you can use the gross yield when just trying to get a surface level indication of which property is going to perform better over time. But it is certainly better. It is certainly worthwhile sitting down and actually running the numbers, doing cash flows on really every property you're looking at, because they will perform differently over time. And, you know, the gross yield only paints a very small picture of that. And sort of the same as the net yield. Like, while it is important to calculate the net yield, you do need actually to do the entire cash flow and do capital growth projections and that sort of thing to really get a clear picture of how that property is going to perform over time. Because the net yield's not going to take into account things like interest rate fluctuations and whatnot. So, yeah.
And capital growth.
Probably the main one.
The main one. I mean, this is how we build wealth with property is through capital growth. Obviously, we want to minimize the cost to own through getting a good yield, but capital growth is really where it's at. And basically, it's just it's a growth rate. How would you explain capital growth?
Yeah, it's a simple future
Alex?
value formula we use. And essentially what it does is uses the growth rate, so it might be 5%. It uses a time period, so let's call it 10 years, and it uses the sort of current value of the property to work out what the value of the property will be in X amount of years. It is a compounding growth rate formula, so it's not a simple growth rate formula, because one of the beauties of property investment is compounding growth, and that's a topic we'll cover super shortly. But yeah, it's a super straightforward formula, and saying that you don't need to memorize it because, again, this particular formula will be written into the cash flow. So yeah, it is a really nice formula to sort of understand and know, though, and you can get more complex with it, but just from a sort of a surface level standpoint, that's it in a nutshell.
And you will see with capital growth how important just a small amount change in capital growth. You know, if you're comparing two different properties and say there's 1% difference between the two, that can make quite a big difference over like a 10-year period, and you know, even greater over a 20-year period. So, as Alex mentioned, compounding capital growth. Basically, I mean, how do we explain this? It's basically if you're looking at a simple interest type scenario, basically here you're getting, say for example, it's 10% on $1 million. You keep getting every year that same 10% on $1 million. Whereas with
you're getting $100,000
every year for the foreseeable future. But with property, obviously the property is growing in value every year. So the first year you get 10% on $1 million, but the second year you get 10% on 1,100,000.
Yeah.
So in each year that grows and grows.
And
so
then it becomes too complicated for us to figure out.
Yeah, it becomes too complicated for us to figure out.
Yeah. But you can use that formula. You have to do it over and over again.
Yeah.
So I guess it's interest on interest, and that is the beautiful thing about property investment. And as Albert Einstein said, it is literally one of the eighth wonders of the world. Well, the eighth wonder of the world, because to earn interest on interest, especially when coupled with leverage, is a seriously compelling argument for investing in property. Obviously, investing in something like shares, for example, compounding interest still applies, provided, of course, you reinvest those returns. But, you know, generally speaking, when investing in shares, you can't use leverage to your advantage.
Yeah, that's right.
Yeah.
And in the examples we'll show you here, there's been no money, apart from the cost to own initially with regards to payments, there's been no money actually put in by the purchaser. They're borrowing against, they're using equity in another property to borrow. So basically there's no money in,
Yep.
but you've got for example, $600,000 asset that's
Mm.
going up in value every year.
Yep.
And it can make a big difference. And that's why when looking at these cash flows as well, it's really important to take the emotion out of it completely and just look at the numbers.
Yep.
Because you might have one property you might be looking at 3 different properties, and there might be one you really like, but that particular property may not stack up as well as the others when you look at the numbers.
Yeah.
Because you might think that's a great location and that should have the best capital growth rate.
Mm.
But when you look at the numbers, it might not.
Yeah.
And maybe it doesn't yield as well either. So really important to take the emotion out of it completely and just look at the numbers when we're looking at these and seeing which property performs the best.
Yeah. Somebody's just asked here, how do we know or calculate what the capital growth rate is? Now, here at the Property Factory, we use some standard assumptions. So we use a standard assumption of 5% for any place in New Zealand, a capital growth rate of 5% for any place in New Zealand other than Auckland. We assume a growth rate of 6% in Auckland. Now, we think those numbers are conservative because on average, property prices in New Zealand have increased between sort of 6 and 7% per annum. That's on average. But what we can do, now, I don't know if I don't know that everybody has access to it. You have to pay for it, I believe. But here we have access to a house price index, which essentially allows us to calculate actual capital growth rates, say, over the last 20 years in a specific location.
For a specific property type as well.
Yeah, so it is interesting in the fact, while we use, say, an average capital growth rate of 5%, just as a standard assumption, the actual growth rate might be, say, 7% in a particular city. And so that has huge implications on the amount of equity in a property over time. So I think for surface, like just for surface level or generally, you'd use 5 or 6%. But if you wanted to get down to the nitty gritty, then certainly it is worth delving into the numbers because, as Andrew said earlier, 1 or 2% can make a huge difference to the amount of equity or the value of a property over a specific time period.
In all their projects, you'll find on the deal page what the capital growth rate 10 and 20 years for that specific property type and that specific location. So if you wanted to run the numbers yourself, you can plug in those specific capital growth rates to see how that particular property would perform.
Just a disclaimer though, as I said earlier, while those are indicators of historic performance, they aren't necessarily indicators of performance going forward, although, as I said, history generally repeats itself. So there is a good chance that growth over the next 20 years will be somewhat similar to that over the previous 20 years. I mean, we haven't plucked those numbers out of the air, to put it bluntly.
And also the properties we're picking are in locations where, for whatever reason, which we've explained in previous webinars, we do expect capital growth to outperform historic in that area as well. So we're doing a number of things to make sure we give you guys the best opportunity for capital growth over the next 10, 20 year period.
Somebody else has just asked if we recommend apartments as well as townhouses. Yep, we do. We recommend standalone homes as well. Generally, what we find is apartments grow in value slightly less than that of a fee simple property or something that is, or a townhouse or a standalone property, but they're certainly right for some investors and their financial circumstances. And somebody else has asked, is capital growth higher in Auckland compared to other cities around New Zealand? Is there a list? We can find that somewhere. Look, historically, Auckland has outperformed most New Zealand cities' capital growth rise. That is because it's New Zealand's biggest city. Well, really because it's New Zealand's biggest city. That's the
main thing. It's got highest population growth.
Highest population growth and biggest really constraint on housing. So that obviously has implications on the price of property going forward.
Surrounded by water as well, and it's not that easy to build in somewhere like Christchurch somewhere in Auckland compared to somewhere like Christchurch where it's flat and there's a lot more land. You're quite restrained by geography in Auckland as well. So historically it has grown faster than the rest of the country, apart from here we go, someone just asked about what about values in Queenstown. So the Queenstown Wanaka area probably has even outperformed Auckland in the last 10 years for different reasons. So the anomaly would be that Central Otago area, which has outperformed. But if you're looking at major centres, Auckland probably has performed the best.
Yeah, one cool thing about Central Otago is we spoke before about the trade-off between yield and capital growth. What we find with some of the developments we've listed and sold in the past in Central Otago is that the yields are really high because there is that tenant demand there, lack of housing supply for tenants to rent, and values have historically gone up relatively quickly as well. So there is, I guess, sort of the best of both worlds there. The trade-off, I guess you could say, is the fact that price points in Central Otago are a fair bit higher than the rest of New Zealand. And so there is a bit of a barrier to entry there. But yeah, we think Queenstown makes sense for a lot of reasons, and growth has typically been super strong down there. Yeah, so just in terms of that, I know we've been talking a little bit about the numbers so far. It is important, memorize the formulas we've spoken about. If you like, we'll send a copy of this webinar out to everybody either this evening or first thing tomorrow. But there's no need to remember them because, as Andrew has said, they are written into the spreadsheet you will also receive. But if you'd like to get out a calculator and have a play around with the numbers, you're more than welcome to do so. But you will receive a copy of both the slides and the spreadsheet as well. So yeah, don't stress if you are trying to remember the formulas, because to be completely honest, I don't think there's anybody out there that loves formulas and algebra, and that's I certainly didn't when I was at school. But anyway, in terms of when you're crunching the numbers on a property, there are a few things to take into account. Things like capital growth rates, inflation rates, rental growth rates, as well as vacancy rates as well. Because I guess what we're trying to say is you will have to make assumptions in relation to these factors or components of the spreadsheet, because we don't necessarily know what they're all going to be moving forward. But yeah,
I mean, and we don't have a crystal ball, as Alex said, so we don't know necessarily what's going to happen in the future. But what we can do is use what's happened in the past and forecast from some of these different institutions like the Reserve Bank to work out how we forecast forward into the future. Capital growth rate, we're using 5%, which is, I think historically New Zealand's been around 7%. So we are conservative there with 5% and 6% for Auckland. Inflation, the Reserve Bank has a mandate to keep inflation between 1% and 3%. We run inflation at the higher end of that just because it's not very often you see inflation on the low end. Normally it's on the higher end and the Reserve Bank's trying to control it. So we've seen a couple of blips, one GFC and another one recently where inflation's gotten quite out of control. And if you average inflation out with these blips where it's way out of the bubble, then, probably average inflation would be 3% or even maybe a bit higher. So that's why we run inflation at the top end of where the Reserve Bank mandate is. Rental growth rate, I think, Alex, that the average rental growth rate's what, 3?
I think that generally it's
3 to
between
5%.
3-5%. Obviously, at the moment it's a little bit higher, as is inflation. But again, we're trying to smooth this out over sort of a long time period. Whoops, have I done something?
Let's come back. Yeah, so basically, rental growth rate, we're just going for the New Zealand average over the past 10 years or so. At the moment, as Alex said, it's quite a bit higher than this, but then in a couple of years' time, maybe, rental growth will be a bit lower again. So we're trying to smooth it out. So when you look at the cash flow, it's all smoothed out, but in reality, there'll be ups and downs within the 10-year period you own this property. But what we're doing is trying to work out, okay, we've got a start and an end point, and those should be pretty accurate. What happens in between may be a little bit different to what's on the spreadsheet, but we have to go with the averages because there'll be ups and downs. But our long-term forecast should come out right in the end or close.
Let's dive into the sheets. Somebody stitched us up there, I think. I don't know if diving into the sheets with you is the first thing I want to be doing on Wednesday night, Andrew, but
sure. Oh.
Anyway,
likes me.
Not that much. Anyway, what we'll do is we're going to look at, this isn't a case study yet. We're just going to look at the spreadsheet itself, go through some of the numbers and assumptions in the spreadsheet, and then what we'll do is look at the case study. And just keeping in mind, just keep in the back of your mind that the numbers in the spreadsheet are actually related to that case study. What we'll do is summarize those numbers in some of the future slides. So you might get a little bit overwhelmed when you see the spreadsheet, but please don't, because as I said, the numbers will be summarized in a couple of slides time. So here is the spreadsheet here. Now, it's super easy to use. What you'll see at the top here are some inputs. So things like purchase price, setup costs, cash deposit, for example, weekly rental income, as well as boring things like rates, insurance, body corporate maintenance, blah, blah, blah. So they're the inputs you as the investor would put into the spreadsheet in order to get the outputs, which are the bottom half of the spreadsheet. Now, those outputs, or the spreadsheet goes for a time period of 10 years, as we mentioned earlier. So you start at year 0, i.e. the day you purchase the property, and it goes through to when you sell the property in year 10. Oh, sorry, at the end year.
Year
So year
9,
10
but
of selling price.
It's basically year 10.
So what we're going to do here is, if we look at what I'm going to do is I'll leave so the inputs at the top here directly correlate with these figures here. It's just important to note you won't need to change any numbers in the spreadsheet. The spreadsheet will do that for you, but you will need to change the inputs here. But again, they correlate to the numbers in year 0. Rent, for example, will grow at a growth rate of, I think we said 4% earlier on a year-on-year basis. Expenses, i.e. the expenses of the property, will grow with inflation. So we're going to call that 3%. And
Just go up a little bit. So we were spoken about some of these economic inputs, but I'm just a bit interested to see how you came up with some of these other numbers, like property management rates, and how do you calculate those?
Yeah, good question. So what do we got here? So we've got property management fees of 8% plus GST. Now, that can obviously change depending on which property management company you use. I've put 8% here because we work closely with a property management company at the Property Factory that charges 8% plus GST. I think they do charge a small letting fee as well.
I think it's a week's rent.
Yeah,
Is that?
something along those lines. But I believe that's actually taken into account somewhere in the spreadsheet too. Yep. In terms of rates, now we have a spreadsheet we sort of use to calculate rates based on the value of the property. Obviously, a property or the rates that coincide with a property will have sort of a direct correlation with the value of that property. I think really for any investment property we're recommending at the Property Factory, you can assume rates will be sort of between sort of 2.5 and 3.5K. I think that's a fair assumption. For this particular property, we've got a residents association. So that's $2,160. Now that number was actually provided to us by the developer, and that number includes insurance. So for those of you that aren't aware, a residents association is something that is set up in most fee simple townhouse developments these days, super similar to a body corporate, although not as restrictive. And for a lot of developments, there is sort of a bulk insurance policy, and that's included in that residents association fee. So as an owner within that development, you'll pay essentially $2,160 to the residents association every year. That will cover your insurance, and that's why insurance in the spreadsheet is 0. In this particular development, there is no body corporate because it's a new build project. We assume that there'll be minimal maintenance. Therefore, we've made that $500 a year. Likely for a townhouse or a standalone home is probably nil.
Less than that.
Accounting, $250 a year. Again, that's just an assumption. It may change depending on how much your accountant likes you or how much of their time they use. And then other costs, we've put $100 in there as well. In terms of selling costs and real estate commission, I'll cover that shortly in some previous slides. That'll be when we talk about the case study. Obviously, a couple of things to take into account as well. Obviously, the purchase price is important because that's going to have implications on pretty much every number in the spreadsheet.
It'll have implications on your cost to own, your equity gain over time.
Setup costs $1,500. Now, this actually seems potentially a little bit low to me. It maybe should be around 2,500. But if you've got a good relationship with your lawyer, you may get away with that. And then the weekly rental income. Now, obviously, that is the amount of rent you expect the property to achieve per annum. If it is a new build, often it won't be completed, so there won't be tenants in there. And we base that number off a rental appraisal. I think in this instance, the rental appraisal was $580 to $620 a week. We use the midpoint, so let's call it $600 a week to be conservative. We don't want to be too conservative though, because we still want a decent idea of how that property is going to perform over time. And then vacancy, we essentially treat vacancy like an expense. We've put 2 weeks per annum, so we assume that in any given year, your property is going to be vacant for 2 weeks. That might not necessarily be the case, but it will occasionally be vacant as tenancy periods roll over, tenants move in and out, and that sort of thing. So yeah, I think it is certainly important to take vacancy into account when... I just noticed Stu here has asked if we recommend managing the property yourself and if you have good tenants staying on. Typically, we recommend an investor does use a property management company, just from there are sort of intricacies when it comes to dealing with tenants and property management and that sort of thing that the average investor may not know about. And just because you think someone's good on the surface doesn't necessarily mean they will be. I guess here at the Property Factory, we encourage a relatively passive approach to property investment, and hiring a property manager sort of just helps with that, I guess. Yeah.
I mean, I would definitely recommend using a property manager. That it used to be a lot easier. There used to be a lot less rules involved in having tenants, but there's so many rules now with the tenancy services are always bringing new things in and things you have to do. And there's a whole lot of things you need to do with regards to insurance as well, like regular inspections and keep an eye on all that sort of stuff. And there's so many things you have to do with property management now.
Yeah.
For the cost, and we've factored it into all our spreadsheets. It's much easier just to have a property manager, and then you can buy property anywhere as well. You don't have to just have it around the road from your house. You can be living in Christchurch and have rentals in Wellington, Auckland, Central Otago, and everywhere. So yeah. I think definitely important to have a good property manager, and they get the right tenants, as Alex said as well.
Yep. Okay, so there are a lot of numbers on the spreadsheet. I think the main ones you want to look out for are the value of the property over time. So here, obviously, we're assuming a capital growth rate of 5%. That property is increasing at a rate of 5% over the 10 years. Rents, obviously, important. We're assuming that's increasing at a rate of 4% over a period of 10 years. The yield, and now this is a gross yield rather than a net yield, is now that just tracks the value of the property along with the annual rent. Again, it looks to be improving over time. Another thing that a lot of investors worry about at the moment is the cost to own, and that's this number here. So this is essentially because interest rates are high, it's very hard to come across a cash flow positive property unless, of course, you put a significant amount of cash in to that property at the beginning. So in this instance, the cost to own the property is $391 a week, or $20K a year. Now, while that number seems daunting to a lot of investors, and it's probably the main factor putting investors off purchasing property at the moment, it does improve over time as A, interest rates fall, and B, the amount of rents raise or go up. Sort of rents we assume to increase at a faster rate than that of inflation, and therefore expenses. So
another thing to note there as well is that 391 a week is the worst case scenario, because that's based on if you were to settle the property today and start renting it out.
Yeah.
Whereas a lot of properties that we're selling might be a year, or in some cases 2 years away from being completed. So in that case, if you don't settle on the property for say 2 years, you almost jump to, instead of looking at this 391 figure, if you settle it at the end of the year, you might be looking at a cost to own of 257. And if the project was 2 years out, which some of ours are, talk to our sales team about which ones they are, the cost to own might only start at 123 a week. So it drops quite rapidly. And you'll see in the coming slides that, that the equity gain during this time period far outstrips the cost to own. So if you can handle that for a couple of years at the start, there's big equity gains to be had later on as the property also starts to break even, further down through that 10-year cycle. I think it's about year 5 or 6 it breaks even. But if you're looking at it, scroll down. If you go across. Yeah, but I mean, even when you get to year 3, I mean, the cost to own becomes minuscule. It's $46 a week, then 26 in year 4. So it improves very quickly. So I think it's important for people to not get too daunted by the initial cost to own, because it's only for a short period of time. And there are ways around this with developers. There's things like cashbacks, where you could put some money aside in an account to cover it for a while. Or, as I said, buy a property that doesn't settle for a couple of years, and then you jump into year 2 as opposed to year 0 on the sheet. And then your cost to own is only $123 a week. So lots of ways around this. And it's probably the biggest thing we have at the moment when talking to existing investors and new investors wanting to get into the market, is that the cost to own is really the big issue. But when you look at it here and break it down, it's not as daunting as you think. I mean, is that what you're seeing out there at the moment, Alex, when you're talking to buyers?
Yeah, no, I tend to agree. Look, we're going to cover the case study shortly, but I think capital growth and while cost to own is painful at the moment, it does, provided interest rates come down, will improve over time, and growth should outstrip that sort of cost to own over a certain time period.
Definitely. We'll see that shortly.
I noticed somebody very intelligent has put here, it says we've put the capital growth rate as 2%. Now you're right, that should actually be 5%. So if I change that to 5, no, where are we? Change this to 5%.
All right.
What you do, you'll see that number changes significantly. So let's look here. Initially it was 2%, right? And so if we change it back to 2%, which you can do in the input section there, the property has increased in value from $599 to $610,000. If it's 5%, for example, it changes to $628,000. And obviously, the longer the time period, the bigger that implication moving forward. So thank you for clarifying that. In the worked example, the growth rate will be 5%. Is that correct, Jonathan? Yeah. Okay, perfect. That's all. Yep. Okay. Now, what we'll do is, I'm just conscious of everybody's time, so we will flick through to
move on to the
worked example.
Move on to the worked example, yeah. So it's basically based off the spreadsheet, but what we're doing is we're just going to have a look at some of the key, I guess, components that we should be looking at.
Yep. So what we've got here, again, it's a development down in Dunedin, and it is a townhouse development. The purchase price of some of the cheaper units is $599K. The expected rent on those is $600 a week. Now, rental yields in Dunedin, i.e. annual rent relative to the price, is super strong. And that's because there is a lack of warm, dry, affordable homes in Dunedin. We've assumed a rates figure of $2,500, $0 for insurance, and residents association is $2,160. Now, again, that figure was provided to us by the developer. Now, this graph here, Andrew, you might like to talk a little bit more about it, but this is essentially showing us what we expect the cost to own to do, or the profit or loss on that property to do over a 10-year time period.
Yeah. So basically what we've done here is made some assumptions around where we think interest rates are going to go over the next 10 years. And what the Reserve Bank, along with a lot of other economists, are saying is that, at some point, probably if maybe 2 years away, interest rates will settle around 4.5%.
Yep.
So you can see the cost to own after year 3 drops quite dramatically, and that's tracking lowering interest rates is the main reason. I mean, of course, we've got rental growth, which is growing a bit faster than our expenses. And obviously the rent we collect is a lot more than our expenses, so that gap will widen. But a lot of it is around interest rates. And they may even drop faster. It's hard to know. Like something could happen out there in the economy, and all of a sudden, we have another quarter which is, negative, and then all of a sudden the Reserve Bank might drop them a lot faster. So we don't know for sure, but we know, looking historically over the last 20 years or so, 4.5% is generally roughly where interest rates average. So yeah, we can see obviously the cost to own improves a lot once those interest rates get lower, and you can see after about, I think it's about what year six it's positive, but after about year 3 the cost to own is very low. And as I said, if you buy a project that's a year or two out, you cut out those first couple of years and you can start at year 3. So talk to our team about that. But yeah, and you can obviously see heading up to year 10, it's starting to put money in your pockets. Some of those losses you made earlier on in the cycle, you can start to use those losses up, moving forward to 10 years. And then if you held the property for 20 years, obviously you can use more of those losses up moving forward. So yeah, important one to be aware of. And
so this is
just looking at capital growth at 5% of that property. So if you bought it at 600,000, with compounding capital growth at year 10, it'll be worth 975, which is a $375,000 equity gain. And obviously, as we'll see in the coming slides, that equity gain far outstrips any cost to own on the property. So yeah, important to be aware of that as well.
It is just important to note, though, that while we've assumed a growth rate of 5% for simplicity's sake, growth rate in this particular area in Dunedin has been 7% historically. So if we plug 7% in there, what we get is a future value figure of nearly $1.2 million, which is obviously significantly different to, I think it was 975.
975, yeah. So huge difference. Yeah, and that's just the difference of 2% in capital growth over a long period of time makes a massive difference.
200K almost.
200K, so
over
it's
200K.
More than 200K, so
yeah,
makes a huge difference over time. So really important to get the right properties in the right area so we maximize that capital growth, because that can make a big difference to something like how early you retire. You might mean you can retire 2 or 3 years earlier, whatever. If you had a few of those properties, you might be able to retire 10 years earlier. So it makes a big difference.
Oh, sorry. Where are we? Yeah, and I guess it's also why it could be a good idea. I'm not saying it's entirely necessarily, but to work with a company like the Property Factory to source your next investment property, because we do have transparency over different growth rates and certain areas and that sort of thing, and that can make all the difference come 10 years time as to how much money actually ends up in your back pocket. And obviously we're always trying to minimize that cost to own as well. So,
yeah, for sure. And we're aware of things that are happening out there in the different communities as well, which will help to boost capital growth in certain areas beyond the historical average, which again pumps this number up, and makes a big difference at the end of the day.
And as we said earlier, like the main thing we find is holding back, or the main factor holding investors back from purchasing at the moment is interest rates and the cost to own or hold an investment property. But it's just super important to keep the big picture in mind. And really this slide here reiterates that. Like, yes, a property will cost you money in the short term, particularly at the moment, but it's important to note that capital growth, generally speaking, will outstrip or will cancel out completely the cost to own that property. I mean, if we look at this example here, so we've got a future value of 975K based on a purchase price of 599 and a growth rate of 5%, or a future value of $1.178 million based on a purchase price of 599K and a growth rate of 7%. Now, the total operating or the rent received on that property over that time period, over a 10-year time period, is 360K. The operating costs are 393K. So if we go rent received less the total operating costs is $33,000. So essentially, an investment property will either make a profit or a loss over a 10-year time period. In this instance, it's essentially made a $33,000 loss.
On the surface.
Yeah, on the surface.
So that 33,000 is what it's cost you to own the property
Mhm.
over that 10-year period.
Yep.
But that doesn't take into account
Yep.
the equity gain you've received on that property during the 10-year period.
So
Yeah.
So if we look at this blue box here, this is essentially a profit once you have sold the property and you're done with it. So you purchase it, hold it for 10 years, sell it. While you have had to make cash contributions to that property over that 10 years, when you go to sell, if the property grows in value at an average of 5% over 10 years, you'll end up with 313K in your back pocket. So that's essentially equity gain less the cash top-ups, 7%, 511,000. So there is literally a $200,000 price or a $200,000 difference there. And it's important to note we take into account the cost to sell as well, which is real estate commissions and lawyers and that sort of thing. So don't be too disgruntled by the fact that property investment is hard at the moment. We always need to keep the long-term time horizon in mind, because at the end of the day, as a property investor, that is what is going to make you better off and ultimately wealthy. Yeah.
And the big thing to be aware of as well is in this example, apart from the $33,000 in cash top-ups over a 10-year period, this investor has put no money into owning this property. They've just borrowed the whole lot, 100% of the value of the property against their existing home in this example. So they haven't actually had to put any money in, but they've managed to leverage into a $600,000 property. So it's the power of leverage, along with the fact that it's only cost them $33,000 over that period to have the investment. And you can see, depending on the growth rate, you're gaining an equity between $300,000 and $500,000 over one property. So, as Alex said, definitely important to keep the big picture in mind when investing in property and having a long-term view in mind. Because I'm sure if we run this cash flow through a 20-year period, I mean, it's gonna be huge. I mean, the compounding capital growth over a 20-year period is even much greater than this. And for simplicity's sake, we haven't done that in this case, but you'd see those profits are huge. And the cash top-ups would be eaten away. You'd be making money over a 20-year period. And with the cash top-ups would be gone.
Yeah.
You'd have a profit there as well. So it's just a matter of having a long-term view in mind with property investment.
And Stu, these numbers have been run on an interest-only basis. We haven't taken the principal into account. In terms of, do we recommend interest-only or principal too? For simplicity's sake, these cash flows have been done on an interest-only, from an interest-only standpoint. But Andrew, do you want to talk a little bit about?
I'd probably recommend not paying down principal if you can avoid it, because it's really just, in a lot of ways, dead money. Because if you look at how much principal you'd pay off over a year, it's really not a lot. It might be $5,000 or something like that for a start, because most of it's interest for a start. And that the money you pay in principal is not tax deductible either. So you're paying money down in principal, but that's actually effectively profit, really. So there's tax to pay on that as well. So I'd recommend not paying down the principal. And you don't really need to. The main thing is really just the difference between money coming in and money going out, and the equity gain over the long term. So if you're paying down principal, it's just puts more of a strain on money coming in and money going out. Because more money's going out than is coming in, even more than this example. And some of that money going out you have to pay tax on. So I'd recommend not. That would be my view.
Yeah. So I just noticed somebody's also asked about repair costs, lawns, and that sort of thing. I guess that's sort of a maintenance expense. We have taken those into account in the cash flows. Without all of the properties we recommend being new builds, those costs are likely to be minimal, but they will increase over time. And so we've certainly taken that into account in the cash flows.
I think it starts off at $500 a year and it goes up every year with inflation. But say, for example, probably that 500 wouldn't be used in the first year, but maybe, it might be used in the third year or whatever. So you might be, building up a fund there for, some sort of maintenance has to happen at some point in the next 10 years.
So that is sort of the worked example. Now, it's important to note when you download the spreadsheet, it won't have anything to do with this example. You'll be able to run your own numbers on any property you like. As I said, it's now your turn to run the numbers. The spreadsheet will be sent out tomorrow morning. If you've got any questions in relation to that spreadsheet, please either give Andrew or I a call, or alternatively go on our website, click on our team page, and any one of our team will be able to run you through the spreadsheet and talk you through it, help you through any scenarios you're going through yourself.
Yeah, and you can use this for any property. And what I'll say again is really just look at the numbers, take the emotion out of it completely, forget about what the property looks like or anything else like that. Literally run the numbers and see which property comes out the best.
Yep.
And that's the best way to do it, because you might be surprised it's probably not the property that you wanted to buy out of the different ones you're looking at, but the numbers don't lie at the end of the day. So, if you want to maximize or minimize your cost to own and maximize your capital gain over the long term, then, follow the numbers as opposed to your emotions when you're buying an investment property. That would be
for sure
my advice.
Yep. And if you are looking for projects, you can find them on our website, on our listings. You can find our listings on our current projects page. Again, though, all of those listings, we will have a cash flow on them. And so we do, as I said, run the numbers on all of the projects on our website. Now, there won't be a cash flow for every single property within a development, for example, because that's just a whole lot of properties to do analysis on. It creates a headache for people. So if you want cash flows done on a specific property, get in touch with one of our team. They are more than happy to do them for you. That's on a property we have listed. If you're looking at a property with somebody else, then feel free to use our spreadsheet too. But again, it's always worth getting a second opinion. Give one of our team a call, one of our investment sales specialists, and they might be able to tell you whether or not they think that property is a good deal or a bad deal or otherwise. And they'll be honest and upfront with you, because at the end of the day, we want everybody we're working with and everybody on this webinar to make money through property going forward.
And these investment analysis, as Alex said, they're more basic. On the website. It'll just show you what happens in year one, and then you'll get a 10-year equity gain. You'll get that information there, but it won't, I don't think, necessarily forecast
that's
every year for the next 10 years today. They're more basic. But you could get the spreadsheet yourself and you can plug the numbers in and forecast that for any of our properties, or talk to one of our team and they'll do it for you. They can also line different properties up alongside each other for you, so you can see how some different properties compare. And you might have seen another property somewhere else out there in the marketplace that we don't have, and you can stack that alongside them as well, and just see how they all look together. So if you're not sure, talk to one of our team and we can help you sort out the numbers and line the properties up so you can see which one stacks up the best. Yeah,
for sure. There's a whole lot of information on our website, a whole lot of collateral, more than most agencies would provide you with. So we're something we're proud of, is all the analysis we do on our properties. But thank you so much for coming along. That is essentially it. If there are any questions, please fire them through now. We've answered a good handful, but we're more than happy to answer more. But everybody enjoy the rest of your week. Enjoy the week.
Day off tomorrow.
And it's been wonderful to have you. We look forward to doing more of them. If there's anything you think we can do to improve, we always welcome feedback. So either drop a comment here or get in touch with us either through our website, shoot us an email. You'll find our contact details on our website. And we've got a pretty exciting topic lined up for next month as well. So certainly come along to that. I think it's going to be sort of an interview with one of our good friends, Rian, who's built up a sizable property portfolio over the last 5 or 10 years. I think he's not even 30 yet. So it's a pretty inspirational story, and I think we can all learn a lot from him. So come along to that. Thanks again, and have a great weekend. Cheers.
Thanks, everyone. Have a good day off tomorrow.